Hey YouTube, what's going on? My name is Tim. I'm the economic forecaster, and I've been on the sidelines here watching a lot of videos on YouTube that people have been talking about the economy, and I've kind of decided to put my 2 cents in. And I just want to let you guys know basically that right now the way I see it is we are in the eye of the storm of this whole situation. We had the collapse on the front part of this, then we had the administration, the Federal Reserve and the Treasury step in and throw a lot of money at this and backstop a lot of debt to try and halt this whole collapse from happening. And for the most part, that's kind of taken a grip now on with what's going on with the economy, more so the markets, and they're not going to be able to keep this thing stabilized for very long. I'm sure what we're going to be seeing on the backside of this whole thing, we're going to be seeing bouts of inflation, and we're going to continue to see the economy collapse to a sustainable level. Unemployment is continuing to be on the rise. Of course, we just had all the information and everything that just came out about these bank stress tests, which really were a complete sham. There's really nothing that you can actually, excuse the pun, bank on from that particular information. Of course, the tests were so lax, there was really no substance to the test, because they basically gave the bank a list of statistics and said basically under these particular circumstances excuse me, how much more capital would you guys actually have to raise. There were no regulators that looked at the books of the bank. The FDIC didn't step in to really take a look at the books to see how much capital they're actually going to need. They really trusted the banks to do an evaluation of themselves, and then of course report how much capital that they would foresee themselves needing in the near future. Of course, how can we put any stock in that at all, given the fact that these banks have continued to lie. They're holding still a lot of toxic assets. They're holding a lot of stuff still off their balance sheets. They've been shuffling paper is what they've basically been doing. And as the economy continues to deteriorate and as unemployment continues to rise, of course there's going to be a lot more defaults that are going to come, and they're going to even need more and more capital, because that debt that they're holding as home values drop becomes even that much more unsecured debt that they have. Now, there's other issues that are going on. Commodities have once again been on the rise with the market. Oil is going back up. Gold has gone up a little bit, and silver. We're seeing a few hints of inflation that are starting to take place in the market. But one thing that I've really been watching and keeping an eye on has been the Treasury, the bond market. And of course, interest rates on like the 10-year have been going up, and substantially going up, even with the Federal Reserve promising and continuing to buy our own debt. We still have the reaction of the bond market, which is that they obviously want to be paid more more reward for the higher risk of holding U.S. debt. So that's a real interest, because of the fact that here again, even with the Treasury buying our own debt, and what we're seeing is we're still seeing those interest rates rise, which means that it's going to be more expensive for everybody to borrow money. And with the economy and the condition that it's in, that's definitely going to again have a drag kind of on the backside of this whole thing. So if you really are kind of tuned into the markets, I would be watching really the bond market more than the stock market. The stock market is a lot more easily manipulated, and the bond market, for the most part, pretty much tells it the way that it is. So I'll be making other videos here on YouTube, and as information comes in on the economy, as data and stuff comes out, I'll be basically giving you my opinion on what that data means to the actual economy, and how soon we are from going into the next leg down in this collapse. Because even if you go back to the Great Depression, if you had looked at the charts for the 1929 crash, and then you see that basically stocks rallied back in the early part of 1930 about 50% of what they had lost before they continued the downslide through the later parts of spring and early parts of summer of 1930. And we're probably going to pretty much see a repeat of that. It might be a little more prolonged, maybe a little bit later in the summer, maybe the early part of fall again, before we actually see the markets really start to once again take a slide. But I think when we start to see them go down, I don't think that you're going to see again a rally or a real recovery in the market for quite some time. We definitely should be making new lows in the market down the road. And again, it all comes down to how long they can continue to try and keep everything propped up. Again, like I had said before, really just watch the bond market. If you really start to see rates really shoot up on treasuries, then you know that that's going to cost the government a lot more money to borrow. And if you just really kind of do the math on that, you can see that the numbers get pretty scary fairly quick. For instance, if the 10-year treasury was to reach, say, 4.5% interest, you're basically looking at about half of the total tax revenues for the United States just to pay the interest on the debt. And things can get out of control fairly quick. So anyway, I hope you tune into my other videos, and I look forward to your comments. Thank you.